Hello, this is Domenico with Easynomics, and today we're going to look at an indirect tax in the context of Spain addressing inflation issues and tax revenue for the Spanish central government. This video is part of a few playlists, but I'll highlight this playlist for real-world examples applied for Paper 1, Part B, Paper 2, type questions. And so it's part of a continuation here where we are looking at the Russian-Ukrainian war and its impact on petroleum prices, leading to a type of energy supply shock causing inflation or cost push inflation. There'll be links in the video notes below to the articles I used to create this paper too. One of the articles was this, and this was discussed in greater detail in other videos, part of this playlist. In the next video, we'll look at the solution of the Spanish government providing a per unit subsidy on gasoline. And in this video, we're going to look at the Spanish bank, the Bank of Spain, addressing the inflation problem, rising pensions, the need for more tax revenue to pay for those pensions. So that's what we're going to focus on here. So we're going to look at question E, and the question asks us to use an indirect tax, illustrate the market for consumer goods in Spain, and discuss the impact of this intervention on price, quantity, consumer and producer surplus, and allocative efficiency, referring to text C, paragraph 5. So here in text C, regarding Spain, Spain's facing 8.3 inflation, and there's a concern that there can be additional cost push inflation as firms may begin to increase workers' salaries or wages, and as wages go up, marginal costs of production go up, and prices of outputs goes up, and that would be just another layer of inflation on top of the energy and food inflation caused by the Russian-Ukrainian war. It goes on to discuss that there could be an inevitable loss of income for the economy. The report should also, and this highlights that pensioners are probably the only stakeholder that will not be directly impacted by the rising inflation in Spain, because by law in Spain, pensions must increase by the rate of inflation. So if inflation is 8.3%, then the Spanish government must increase pensions by 8.3% to keep up with inflation. So that will drain tax revenue from the central government to pay for that increase in pensions. So the question is, where will the central government of Spain get more tax revenue to pay for the increase in pensions? And the Bank of Spain proposes an increase in the Spanish value-added tax, or IVA, an ad valorum tax, to the standard 21%, which is quite high. On those products are charged just 10 or 4%. So instead of having 10 or 4%, raise it up to 21%. And that's what we're being asked to graph. So let's go ahead and do it. So here we have the question, graph I, the market for consumer goods in Spain, measuring price on the y-axis and quantity on the x-axis. Keep in mind that there's two different types of taxes that we're responsible to know of in the IB. Specific tax, which is a fixed amount of tax per unit sold. So if the tax was, let's say, $5, it would be $5 for each unit. Regardless of the quantity of units, the tax is always $5 per unit. So that would cause the supply curve to shift up in parallel by the value of that fixed tax. The Spanish government is talking about raising the tax from 4% for some items or 10% for other items up to 21%. So that is an ad valorum tax, a fixed percentage of the price of the good. And that's going to cause the supply curve to have a slightly different shape than the parallel shift of the specific tax. So on an IB exam, you don't necessarily need to illustrate an ad valorum tax supply curve, but we will for this video. Okay, so let's go ahead and do it. All right, let's get rid of this and go ahead and illustrate this tax. And then we'll analyze it and evaluate its impacts. Okay. Oops. All right, so first, let's illustrate the supply curve. Let's assume that since this is a consumer good market, we're going to assume that the PED and the PES, let's just make an assumption that these products face substitutes and so on. So let's assume that they're both relatively elastic. So PE, the supply curve, will have a relatively elastic supply curve. We'll label that S1, which is equal to our marginal costs of production. We'll have our downward sloping demand curve equal to our marginal benefit. Demand 1 equal to the marginal benefit. And that establishes an equilibrium here at point A. We'll have an equilibrium price and equilibrium quantity in the assumed free market. Price at equilibrium, quantity at equilibrium. Okay. The area below the demand curve up to the price is our consumer surplus before the government intervention, and the value of the area above the supply curve up to the price is the value of the producer surplus. So the government wants to raise the tax from 4% or 10% tax going up to a 21% tax. So that's an ad valorum tax. And so the supply curve would have kind of this type of shape, approximately. So here we have S2, which is equal to S1 plus the tax. And that sets a new equilibrium right here. So here at point B, we have the increase in the price for consumers. So I'll label this PC, price paid by the consumer, and I'll set the output here. And we'll label that quantity with tax, Q with the tax. All right. We can label this point C, and you'll see why. This will be the price received by the producer. Okay. So the distance between PC and PP is the value of the tax at this quantity of Q tax. All right. Let's just improve the labeling here just a bit. Quantity with the tax. Okay. Now let's label some areas. And actually, let me have the demand curve connect with the axes. And we'll do that for the supply curves as well. Okay, more or less. So now we're going to label some areas so that we can discuss the impact on consumer surplus and so forth. So this will be area A, B, C, D, E, F, G, H, and I. Okay. So we're basically done. We've drawn it, and now we can fully analyze it. To help us understand this, I'm going to go ahead and shade in some areas so that we can clearly see the changes. So this will be the reduced consumer surplus, area A, as a result of the tax being imposed. There we go. And then we'll have the reduced area for the producer surplus, which is this area here. And then we'll have the tax revenue shaded in. It's this rectangular area here. And then we'll have the welfare loss, which would be this triangular area here. Okay, perfect. Point B, we can just make a note that this is equal to our marginal cost. And right here, the marginal benefit. And here's our marginal cost at this point, marginal cost. So we see MB is greater than MC, so it's under allocation. Great. So let's go ahead and analyze this as we would for a paper exam. As can be seen in graph I, the market for consumer goods in Spain, we're measuring price on the x-axis and quantity on the price on the y-axis and quantity on the x-axis. We have a downward sloping demand curve labeled D1 equal to the marginal benefit. We're going to assume that in this market for consumer goods, there's plenty of substitutes, so the PED value is greater than 1. It is elastic. Since the consumer goods are manufactured goods, we'll assume that the upward sloping supply curve labeled S1 equal to our marginal cost is also elastic. So we have an initial equilibrium set at where S1 equals D1 that provides an equilibrium price at PE and equilibrium quantity at QE in the free market. And then the Bank of Spain is proposing that taxes, ad valorem taxes, be increased perhaps for some goods from 10% to 21%. So that would cause the supply curve to shift upward from S1 to S2, S2 equal to S1 plus the ad valorem tax. That sets an equilibrium where S2 equals D1, provides a higher price for consumers at PC, and reduces the quantity to quantity at tax. Quantity supplied and demanded is reduced to quantity at tax. We can see here that at the higher price, along our demand curve from point A to point B, quantity of demand decreases from Q1 to Q tax, and the quantity supplied along the S1 curve decreases from point A to point C because the price received by the producer falls. Price received by the producer falls from PE to PP, so quantity supplied decreases from point A to C or from QE to Q tax. Price paid by consumers increases, so the quantity demanded decreases from point A to point B or from QE to Q tax. We can notice that at the quantity of Q tax, the marginal benefit at point B is greater than the marginal cost at point C. So there is an under allocation of resources to the production and consumption of this good versus what is desired by society at point A, where at point A, marginal cost equals marginal benefit and is allocatively efficient. So we've talked about price, we've talked about the change in quantity. Now let's discuss consumer and producer surplus. Originally, consumer surplus, and I'll label this like this, consumer surplus was equal to areas A plus B plus C plus D. Then consumer surplus after the government intervention is equal to areas A, just area A. So there's a reduction in consumer surplus, so consumers are worse off due to the increase in price. What about producer surplus? Producer surplus before was equal to areas G plus F plus E plus H plus I. After the government intervention, producer surplus is equal to areas H plus I. So producers experience reduced surplus. In addition, we also see that total revenue has been decreased. Total revenue was originally PE times QE. Now it is total revenue 2, a lower price received, PP times quantity at tax. So we can see that total revenue 2 is less than total revenue 1. So firms are also worse off in that respect. Workers for firms providing these consumer goods can also lose their jobs. Since firms are reducing the quantity supplied from QE to Q tax, they will fire excess resources, and thus unemployment may rise in the macroeconomy. What's the benefit? The central government of Spain gains tax revenue. Central government tax revenue before was less than what it will be with the increase in tax. It'll be equal to areas B plus C plus G plus F, which is the green boxed area that you see above. So the central government gains additional tax revenue to pay for the increased pensions to retired workers. And we also have a welfare loss. A welfare loss equal to areas D plus E, where at Q tax, the marginal benefit is greater than the marginal cost. There's under allocation of resources to the production consumption of these consumer goods versus what is desired by society. So the Bank of Spain is proposing this positive to the stakeholder of the central government, but there's plenty of negatives with this proposal to go around. Consumers are negatively impacted, producers are negatively impacted, workers or producers are negatively impacted, and we have under allocation. In addition, as you discuss this in your evaluation, you may also highlight that an increase in tax is a non-price determinant, or is a shifter of the SRES curve. So we have a change in indirect tax, change in indirect taxes will cause the SRES curve to shift. So as this supply curve at the micro level increases, at the macro level, it will also increase. And let's just assume a parallel shift here. So it's going to shift. Now, first, let's take into account, let's assume that Spain was at point A, full potential with price level at PL1. And in previous videos, we talked about how the Russian-Ukraine war caused a supply shock, which we can see here. All right, in this perfectly competitive market structure, we can see that there's a crude oil supply shock, energy price will rise as this shifts in. Individual firms will see an increase in profit, but at the macro level, SRIS is going to shift in or upwards by the value of that. So here we have cost push inflation caused by the rise in energy prices. Price level going up, GDP going into recession in theory, PL2, Y recession 1, we're at point B. So Spain's at this point of inflation due to the Russian-Ukrainian war. And this proposal by the Bank of Spain will just continue to add to that problem. So if VAT taxes or ad valorum taxes increase, SRS is just going to shift in again. And you'll have more cost push inflation. So we're going to go from SRS 2 to SRS 3, and we'll have a higher price level and reduced economic output in the economy. PL2 going up to PL3, point C, and going to Y recession 2. So it doesn't seem like a fantastic idea, but the Spanish government is desperate for tax revenue to pay for those pensions. So there's kind of plenty of negatives here to the economy. And that's it. If you have any questions, feel free to comment those questions below, and don't forget to subscribe and to like. Thank you so much.